Hello, everybody. My name is Doug Huber, and I'm the Deputy Chief Investment Officer here at Wealth Enhancement. We wanted to come to you today with a special communication surrounding the U.S. and Israeli military strikes on Iran over the weekend. This event is understandably drawing investor attention as the markets reopen today. And while the most important focus should remain on the safety of our troops serving in theater and for the civilians living in those affected areas, we wanted to provide some thoughts and observations on the impact these events are currently having on our financial markets. Historically, geopolitical events, while certainly unsettling, have tended to have limited and short-lived impact on the broader equity market, unless they directly involve a major developed economy or materially disrupt economic infrastructure. And I think Iran's direct footprint in the global economy is very small. It represents less than 1% of global GDP, and it's a modest share of global trade flows. The more meaningful economic channel to monitor is energy. Iran is a significant oil producer, I think the number 2 in the world. And more importantly, the Strait of Hormuz, which borders Iran, is a critical choke point through which roughly 20% of the world's daily oil and liquefied natural gas, liquefied natural gas pass through. And so the disruption to these shipping lanes has certainly led to a spike in volatility for oil and nat gas prices. Oil is up roughly 7 to 8% today. And so that certainly has longer impacts the longer this goes on, right? This could influence inflation expectations and certainly near-term market sentiments. And so what the market now must wrestle with is a larger framing issue. Is this a beginning of a prolonged regime change campaign similar to what we did in the early 2000s in Iraq and Afghanistan? Or is this a short targeted shock intended to force negotiations with Iran's regime? And so I think that distinction is going to matter enormously for markets from here. If it's a contained episode with kind of a rapid diplomatic engagement, we'd likely see this volatility fade. But a prolonged conflict that entangles energy productions, exports, shipping lanes, that's going to require markets to price in a more durable shift in risk. And so what could that lead to? I think we could see a more sustained spike in oil and higher gas prices. That would thus put upward pressure on inflation and budgetary concerns. And what that does is then it complicates further the Fed's easing path. And so that ultimately, if you put that all together, that really could put a more stagflation-like drag on the equity markets. At this time, all signs are indicating to us, at least, that the U.S. is not looking to engage in a prolonged regime change campaign. And so that bodes well for global markets, I think, both in the short and long term. And I think you're seeing that price in today as markets in the U.S. are down, between 0.5% to 1%. Bonds are staying relatively steady. Oil obviously spiked, but the market reaction has been, I think, a bit muted compared to what the initial shock was when we first conducted the campaign on Friday evening. Historically, geopolitical shocks do produce that kind of an initial risk-off tone, and we're seeing that right now. But if you look historically, whether it's at prior campaigns in the Middle East and even going back to prior wars, there's usually a stabilization within days to weeks. And most times, and more often than not, there's a recovery unless there's really that hit to that global economic infrastructure I had. And so you can look kind of 6 and 12 month post these geopolitical events. And more often than not, almost 9 out of 10 times, the market is up following these events because they're usually in areas and affect parts of the economy that aren't massively disruptive to the broader global situation. Here at Wealth Enhancement, our portfolios are built with these scenarios in mind. We try to balance some amount of high quality growth opportunities, but we do so in a risk optimized framework. And it's important to keep that in mind. Right now, we're actively monitoring the situations. Things are changing very quickly. We're obviously keeping the closest eye on the shipping and energy infrastructure developments. We'd like to see that the Strait of Hormuz is technically open, although traffic is not passing currently. So we'd like to see that open up a little bit more. OPEC, the oil producing nations, have agreed to resume oil production increases at a slightly accelerated pace. So that could help. But we got to get that oil out of there. And so it'll be important to, again, keep an eye on how the shipping lanes are progressing. We obviously want to keep an eye on what the retaliatory scope of this looks like. How far can Iran reach? How long do they continue to push against some of their neighbors and bomb areas like the UAE, Saudi Arabia, Oman, Jordan, Beirut? And what will their impact, what would their retaliation look like back towards Iran? Obviously, if we can avoid energy infrastructure, that's a positive. We're keeping an eye on credit spreads in the CDS markets to see, how is the markets pricing a bigger risk? Typically, you would see that show itself in the credit markets first. And then we're obviously keeping an eye on just what is volatility looking like in the markets. again, with these bouts of uncertainty, there is an inclination to take risk out of portfolios by market participants. You see that, and like we said, there's that short-term impact, but it usually rights itself pretty quickly as the duration of this conflict gets a little more clarity. As always, diversified portfolios are designed with these type of risks in mind. And history constantly reminds us that maintaining discipline in these periods that are uncomfortable, that really leads to the best long-term investment success. And so we will be back later this week with our typical 7 Market Movers video series, where I'm sure we'll get into all the updates that have gone on over the last several days. But until then, we wanted to give you this update, and we look forward to talking to you later this week. Thank you so much.